Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In this video, I will be speaking about gold. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, so the COT data, so essentially what hedge funds and the big players in the market are doing and how they're moving their orders. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. If you're new to the channel, make sure to subscribe. This is the place to be for high quality free trading education. Now, without further ado, let's jump straight onto the charts. Starting here from the monthly time frame, what we can see is that we have a market which at the moment is testing and rejecting to the upside a quite strong historical structure level for this market. This zone, in fact, was acting as previous resistance, preceding all these rejections to the downside. Then the market broke above the zone with this impulse, and at that point all this previous resistance was turned support. The market tested that previous resistance turned support exactly here and started rejecting it to the upside quite aggressively. So from a monthly standpoint, the situation is quite clear. We have a market rejecting to the upside a quite strong historical support and demand area. And if we look at the pattern, we can notice how the last movement was an impulse, correction, continuation to the upside, and in the natural movement of the market, when the market is in an uptrend, you expect to see the creation of higher highs and higher lows, therefore impulses and corrections. And every time you expect the previous high to be higher and the previous low to be higher as well. Because in an uptrend, the market is creating higher highs and higher lows. Therefore, in a situation like this, the next logical step would be first to see a correction and then the continuation to the upside. Basically, for the market to first create a new higher low, so a low here higher than the previous one here, and then the creation of a new higher high, higher than the previous one that we have at this point, meaning that from a monthly perspective, we could expect some short-term bearish price action to be created. And in fact, the market has already started creating a move lower, since we can see here how we had the creation of this wick. Dropping down on the weekly time frame, what do we see? Well, from a weekly perspective, the situation is actually quite similar. We can notice how we have an impulse to the upside, correction, continuation to the upside. Now the market has started again a correction. And if you have an impulse and you want to measure the correction, what you have to do is take your Fibonacci from the low to the high of the impulse leg. And if we do that, we can see how we have the 0.32 50% and 0.618 Fibonacci retracements, which at the moment are all lining up exactly in this zone. Therefore, what we could expect is to see us a bit more short-term bearish price action for the market to really go and test this level to see what kind of liquidity there is inside of the zone, and then to see the rejection to the upside away from this area. So both the monthly and weekly time frames suggest some potential short-term bearish price action and then more longer-term bullish continuation. Dropping down on the daily time frame, what do we see? Well, from a daily perspective, I did speak about gold quite a few times in the past. I spoke about it when the market was around this area. I explained all the reasons for which we could expect this push higher. Then after this break and retest when the market was here, explained all the reasons for which we could expect a rejection to the upside. Again, after this impulse and this correction, explained all the reasons here from which we could expect this move higher, retest of structure, and continuation to the upside, which again is exactly what the market did. And just a few days ago when the market was around here, I explained all the reasons for which we could expect this move higher, completing the M pattern at the neckline. And again, that is exactly what the market just gave us. And by the way, I will link in description all those previous analysis so you can go and check them out for more free education. Now, let's continue with analysis. Well, before we go deeper into the technicals of what we have here on the daily time frame for the pair, first, let's go and see what we have when it comes to the commitment of traders. So what hedge funds and the big players in the market are doing, and let's analyze the data precisely for gold. Now, what we can see is that in the long run, net positions definitely have been increased. We went from having 131.1k net positions all the way up to 202.8k net positions. So we had a huge increase of the net positions, meaning that institutions were moving back to the bullish side for gold, therefore increasing their longs, which clearly have rose from 211k all the way up to 279k. However, we can also notice that if we look at the very last reports, shorts have now started to be increased once again, also from an institutional perspective. We can see how we went from having here 66.3k net shorts all the way up to having 76.6k shorts. So at the same time, institutions first were just increasing their longs and decreasing their shorts. Then from here, when they had 66.3k shorts, they have started with the last reports clearly increasing their shorts. What this means is that in the long run, gold is bullish. Net positions have been increased quite massively, as we just said, from 131k to 202k. So institutions in the long run, they do expect gold to go higher. However, in the short term, they are adding shorts. Therefore, it means that some institutions do expect a correction. Now, let's keep that in mind and move back here to the charts, because if you remember, already we have seen by looking at the monthly and weekly timeframes that there is definitely the possibility to see short-term bearish price action and then longer-term bullish continuation, which is exactly what we have just seen here that institutions expect as well. Now, by the way, if you still haven't, make sure that you join my free Telegram channel, which you see here on the screen and also linked in the description, so you never miss new updates. Now, back to the analysis. So, as we were saying, both the technicals and the commitment of traders both indicate the possibility of seeing some potential short-term bearish price action, then longer-term bullish continuation. So, if we look again here at the technicals, what we can see is that this area is in fact a resistance area, because here we have previous daily support, which was then broke to the downside, and previous support, once it is broken to the downside, becomes resistance. And we can also notice that if we have an impulse and correction, as we said previously, if we want to measure the correction, we have to take our Fibonacci from the high to the low of the impulse leg. And what we can see here is that we have the 0.32, 50%, and 0.618 Fibonacci retracements lining up exactly with this previous daily support turn resistance, therefore creating a confluence of resistance inside of this area that we could in fact expect this market to potentially reject to the downside, because when you have a confluence of resistance area, there is a higher probability to see even more institutional shorting, which at that point would further increase the probabilities of a potential push lower below the zone, because clearly already institutions have been shorting. So in a situation like this, what would I expect? Well, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, if this market would shift from an intraday bullish to bearish market, at that point, I definitely wouldn't be surprised to see a potential push lower, completing this daily impulse correction and impulse pattern to the downside. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked both in description and on the main page of my YouTube channel. Here, you have the possibility to gain access to the most complete all-inclusive mentorship program that I have created for you. As soon as you open the website, you will see this video breaking down everything included in the mentorship program. And in the program, you have the possibility to gain access to all my courses and also to the software, so the COT data software, which is exactly the one that we used in this analysis, the trading station software with Telegram signals integration, which puts together everything that you need as a trader all in one interface. You also have the possibility to gain access to one-on-one private mentoring directly with me, so you will have my personal contact. And if you continue to scroll down on the website, you will see that directly from the website, you will have the possibility to register and gain automatically access with the email and password that you will create during the registration process. So at least I suggest that you go and check it out right now. The link is both in description and in the main page of my YouTube channel, and I will see you in it. If you enjoyed the video, make sure to drop a like and also let me know in the comments below any new pairs or topics that you would like me to cover in the next videos. And I will see you in my next breakdown.